Continue our coverage of all the market action. Cam Peacock from IG Markets in Melbourne joins us now. Cam, look, as expected, indeed as IG called, we're seeing the market down about 1.1% at the moment.
Yeah, good morning, James. That's right. About an hour before trade kicked off, we were calling the market down about, I think, about 37 points, 0.9% around that 4,050 level. And just looking down at my screen, we've hit a low of 4,042, currently trading right around those levels, down about 1% at 4,045. Now, I think it was always going to be a day of fairly broad-based losses for our market. Last night, obviously, in the US markets reacted poorly to that sort of synchronised slowdown we saw in global manufacturing activity. When you think about it, in the last 24 hours, we've had some pretty poor manufacturing data out of China, out of Europe, out of the US, and that's seen these cyclical sectors leveraged to the sort of global growth story, selling off the hardest. I mean, we saw the energy sector in the US down 4%. We're seeing crude prices overnight down 2.6%, trading around that $78.30 a barrel level. It's the lowest level since October last year. Similarly, the materials sector was down 3.6% last night. We saw money flowing back into the US dollar. We saw the likes of gold down sharply, base metals down sharply, and hence, we're currently seeing the likes of BHP down 2.7%, Rio down 2.4%, Fortescue down about 0.4%. So those cyclical sectors obviously getting crunched, and then you've got maybe some flow-through effects from those Moody's downgrades across the financials. I personally don't place much of a link between our financials and the US financials, but our financial sector also down, sort of in the vicinity of about 0.6%, with all those majors trading a little bit lower. So, disappointing way to end the week. We have given back all the gains we had seen. I think we were up about 0.7% coming into today's session. So it looks like we're going to finish the week in negative territory.
Look, Cam, I think it's a good point you bring up. It seems the banks very much our banks getting caught up in the swirl of negative sentiment off the back of the Moody's downgrades. But in your opinion, is it right to be, I suppose, having some sort of connection between them? Because all the I suppose, analysis and data suggests our banks are pretty good health.
Yeah, look, I think, you're just seeing one of those days where you've got indiscriminate selling across the board. I think regardless of the Moody's downgrade, I think obviously the US selling intensified in the last hour once it became known that these downgrades were coming. But, I think our banks were going to be down, whatever they are now, just looking down at my screen, maybe 0.8% today anyway. I don't place much of an emphasis on the Moody's downgrades. Those downgrades are specific to those US banks and their exposure that those banks have to Europe and the issues going on there. Our banks have come out and have said that we've got very little exposure to those European banks and the issues going on in Europe. So I wouldn't place too much of an emphasis on that. But I just think broadly speaking, the market's really bereft of confidence at the moment. There's a multitude of issues going on across Europe. We're seeing these coordinated global slowdown in manufacturing activity levels, and confidence is pretty much shot at the moment. I think there's a lot of fund managers and investors that are quite frustrated at the moment that we take 2 steps forward and then 1.5 or 2.5 steps back, and we seem to be going absolutely nowhere. I mean, we had a great start to the year. The first quarter was a record quarter, and then we seem to have given it all back in this subsequent quarter. So I think people, along with tax loss selling, which we're seeing at the moment, really just throwing their hands up in the air. And I see the market probably trading, bouncing around these current levels for at least the next week and a half until we get into that new financial year.
Yeah, you wonder if the sell-off on the US session was a little bit overdone. I mean, at the close, you saw the US futures actually opened up into positive territory. And I wanted to get your thoughts. Something Chris Kimber made mention of there. Goldman's basically coming out and saying they're shorting the S&P, telling investors, we expect it to drop by some 5%. He's quite right. Just a month ago, a few weeks ago, they were suggesting they hadn't seen a better time to buy equities.
Yeah, look, in my view, anyone that places any emphasis in an investment bank's price targets or rating agencies' upgrades or downgrades has got rocks in the head. I mean, they flip around like a fish out of water. As you said, Goldman Sachs probably a month ago saying it was a great time to buy. They turn around and a couple of weeks later and say it's a great time to sell. It's the same with currency strategists. Everyone sort of chops and changes. So that's why I think you've got to be short term in your thinking and nimble in this market, because you can say you're a long-term investor, but you can have these big corrections based on people maybe making recommendations to suit their own book. So something for investors to watch very carefully.
All right, Cam, great to talk as always. Thanks very much.